Hello learners, today we will be discussing on final accounts. So preparation of this final account is a last stage in the accounting cycle. So far we have discussed the other stages of accounting cycle: journaling, how to prepare ledger, and how to transfer the journal entries to ledger, and from ledger balances how to brought down the ledger balances to preparation of trial balance. So today we'll discuss how to prepare the final accounts. We will see what is the theoretical aspects behind final accounts and the pro forma of final accounts. So in final accounts there are two items involved. One is the income statement, the other is the balance sheet. In income statement, the manufacturing and trading account comes, and the other one is profit and loss account. So the basic objective behind preparation of this final account is to analyze the financial creditworthiness or the financial soundness of every business in a particular year or a financial year. So the basic objective of every organization by maintaining this book of account is to find out the profit or loss incurred in the business at the end of every year. The final accounts include manufacturing and trading account, profit and loss account, and the balance sheet. Determination of profit and loss account is done by preparing trading and profit and loss account. So to determine whether the business is running in profit or loss, the business organization or the firm used to prepare the final accounts, which are the income statement, which shows the statement of income, whether the income is in profit or whether the organization is in loss. So the manufacturing and trading account, profit and loss account is prepared for the determination of profit and loss. The purpose of preparing balance sheet is to know the financial soundness of a concern as a whole during a particular period. As you know, every final account will be prepared for a particular year, for a particular time period. So this balance sheet and the income statement is prepared for a particular year, and the balance sheet help to identify what is the financial soundness or the creditworthiness of an organization. What is income statement? So we'll deal in detail what all falls under the income statement and why income statement is prepared and how to prepare. Trading account and the profit and loss account are the two important parts of income statement. Trading account is the first stage in final account, which is prepared to know the trading results of gross profit or gross loss during a particular period. So this trading account helps to identify the gross profit or whether it is in gross loss. And in income statement, initially we will be preparing the trading account, after that profit and loss account. So this it is the summary of the purchases. The trading account is the summary of purchases and sales of a business or production cost of goods sold and the value of the sale. So in brief, the trading account means it gives a summary of purchases and sales of a firm. How much items purchased, what was the value of the purchase, and how much sale happened, what was the income generated from the sales, and what is the production cost of the goods sold, and what is the value of the sold item. So these all things will be these all things we can get from the income statement, or the looking into the trading account. All these details will be cleared. The difference between the elements established the gross profit or loss, which is then carried forwarded to the profit and loss account for the calculation of the net profit or net loss. So in trading account, in income statement, there is first stage include the preparation of trading account, and in the second stage, that is profit and loss account. So in trading account, what we prepare is, we look into is, we will be giving a summary of the purchase and sales, and gross profit or gross loss will be determined in the trading account. And when it comes to the profit and loss account, the net profit and net loss will be analyzed. In trading account, gross profit and gross loss, and in income statement, net profit and net loss will be analyzed. And the items, the gross profit and gross loss, which is calculated or determined in the trading account, will be transferred or carry forwarded to the profit and loss account. And profit and loss account is generally called P&L account in short. Accordingly, if the sales revenue is higher, that means the revenue generated by sales is higher than the cost of goods sold. Cost of goods sold means there will be production cost involved. So if the sales revenue is higher than the cost of goods sold, it is known as gross profit. So the firm is in gross profit. Similarly, if what happens if sales is revenue is less, that means revenue is less than the cost of goods sold, then that is loss. Like if the revenue generated by sales is more than the cost of goods sold, then that is a gross profit, and if sales revenue is less than that of the cost of goods sold, then that is a gross loss. Now, what are the elements involved in trading account? As we know, for every financial transaction there are both sides, two sides, that is the debit side and the credit side. So same as that in the trading account, there are two sides. In the debit side, the items falls are opening stock that will be carry forwarded from the trial balance. The purchase and purchase return will be there, then we have to give the purchase minus purchase return. Direct expenses, all kind of direct expenses incurred in trading will be enlisted, and gross profit is the excess value of sales over the cost. So gross profit will be, if that is gross profit, that will be enlisted in the debit side. And now looking into the credit side, what all things falls? Sales, opening stock will be always written in the debit side, and the sales amount will be written in credit side. If there is sales return, then have to be deducted from sales, so sales return in the credit side. Closing stock will be always written in the credit side. Opening stock in the debit side and closing stock in the credit side. And gross loss, if gross loss is it is loss, that is sales revenue is less than the cost of goods sold, then that is a gross loss. So gross loss amount will be mentioned in the credit side, and if the firm is in gross profit, that will be mentioned in the debit side. So what is this gross profit? Gross profit is sales minus cost of goods sold, that have been explained earlier, and sales can be also calculated by cost of goods plus gross profit. Just the same equation have been written, and so this is the elements involved in the trading account. Now this is the performer of a trading account in brief. So both sides, the debit and credit side, debit side falls in the left side and credit side in the right side, just same as that of the trial balance. There are particulars involved, the opening stock and the closing stock you can see here in the credit side. So opening stock in the debit side, closing stock in the credit side, and all these direct expenses are enlisted. Sales this is gross sales minus sales return, purchase minus purchase return, and finally the gross profit here. Gross profit here is here, and this is the gross profit or gross loss, whatever be the thing. If that is if that is gross profit or gross loss, whichever be that, if that is profit or if that is loss, that will be transferred to the profit and loss account, that is a P&L account. Okay, so the performer of trading account is clear. Now we'll look into profit and loss account. What is this profit and loss account? The purpose of preparing profit and loss account is to calculate the net profit or net loss of a concern. Net profit refers to the surplus which remains after deducting related trading expenses from the gross profit. Okay, that means net profit, the profit and loss account, we are calculating the net profit and net loss. And what does this net profit means? It is a surplus which remains after deducting the trading expenses from the gross profit. Once we prepare the trading account, we will be minimizing all the trading expenses from the gross profit. That amount is termed as a net profit, and this net profit or net loss will be carried forwarded to the profit, will be prepared by, at the end of the profit and loss account. The amount which we will be getting is the net profit or net loss. So that is gross profit minus the trading expenses. So the trading expenses includes the office and administrative expenses, selling and distribution expenses. All these expenses are included in the trading expense. So that is trading account minus trading expenses is the net profit or net loss. So the trading expenses are which include what are the expenses included in the trading expense, which are the office and administrative expenses, selling and distribution expenses. In other words, all operating expenses such as office and administrative. Trading expense means what for a firm? What are the operating expenses? All kind of operating and non-operating expenses for the working of a business that is involved in the trading expense. So all there are two kind of expenses in trading expense, that is operating expense and non-operating expense. So operating expense, which include the administrative office and administrative expense, selling and distribution expense. Non-operating expense are shown in the debit side, while all the operating and non-operating gains, that means the non-operating expenses means that is a kind of like loss, kind of small kind of expenses are shown in the debit side, and all gains and incomes are shown in the credit side. Okay, all kind of incomes generated, revenue generated are enlisted on the credit side, and all kind of expenses will be enlisted at the debit side. So the difference between both sides, the debit and credit side, will be either net profit or not the net loss. Either that will be profit or that will be loss. Okay, the total of all operating and non-operating expenses less than gross profit is the difference, is the net profit, and reverse is the case of net loss. So what it is, total of all operating and non-operating expenses minus gross profit is, that is the net profit, and the net profit or net loss is transferred to the capital account. Capital account is the balance sheet. Okay, so now we have seen the final accounts. What are the final accounts, how to prepare the performer, what is the purpose of preparation of final accounts, all those things are, all those concepts are clear to us. So now we will see what is the difference between profit and loss account and balance sheet, because they both falls under the final accounts. Then how it is different? So it is different in a way, the profit and loss account, it is prepared with debit or credit balances of nominal account. Nominal account, that is our ledger balances, and this balance sheet, it shows the assets and liabilities on a particular date, for a particular date, and the profit and loss account reveals the net profit or net loss of a concern during a particular period, and the balance sheet, it is a statement of financial position for a particular day. So the P&L shows the net profit and net loss, and here the balance sheet shows the financial position or the credit worthiness. Third point, it is the P&L account. The difference between two sides of the trading account will be gross profit, that will be transferred to the profit and loss account. Here in balance sheet, the difference between two sides of profit and loss account will be net profit or net loss, will be transferred to the the balance sheet. That is, from trading account, the net profit or loss, that will be transferred to P&L account, and the net profit or net loss that we receive in the P&L account will be transferred to the balance sheet. And finally, the debit or credit balances of nominal accounts are closed by transferring P&L account, transferring to the P&L account. And in balance sheet, it is a statement of a static in nature, thus the account do not require to close them, because it is a statement which shows a financial position for a particular year or a particular time period. So there is no need to show the transfer them. So this is all about the financial statements or final accounts. So all the concepts in regarding to the final accounts are clear. I hope everything is clear, and we'll see how to prepare. We will further we will do the practical problems on balance sheet preparation, trading account, P&L account, and all. So the concepts, once we do the practical, the concepts will be much more clearer to you all. Thank you all. So this is the performer of a profit and loss account. So you can see both sides, debit and credit side. Debit and credit side is there, and to the opening stock, same as that of the trading account, you can see opening stock is there, purchase minus purchase return, carriage inwards, that is to wages, like all kind of direct and indirect expenses are returned, all the expenses are returned. And finally, if that is net profit, the net profit will be returned in the debit side. And same as that in the credit side, you can see the particulars by sales return and gross loss. This is the trading account, and from there the if that is gross profit brought down, that will be written in the credit side. If that is gross loss, that will be carry forwarded to the debit side. You can see this. If that is gross profit in trading account, that profit will be carried down to the debit side once we prepare the P&L account. And if that is gross loss in the trading account, that will be carry forward, that is brought down to the debit side. So this is how P&L account is prepared, and these are the particulars, or these are the performer of this is a performer of a profit and loss account. These are the items involved. You can see these are the items involved. All the direct and indirect expenses are there. All the expenses of operating expense, selling expense, administrative expenses, all of them are there. You can see here administrative office and administrative expense, there is a heading, and all the kind of office expenses are written: office salary, rent, printing, stationery, phone charges, audit fees and all. Then to selling expenses, there were for selling, advertising, discount allowed, commission, the payment to the salesman, salaries, go down rent and all those things. And traveling expenses, all those things are also mentioned. The non-operating expenses include the discount and issues of discount issued on the shares of the business. So, and all those direct indirect expenses, office and administrative and selling, distribution, all those expenses are mentioned in the debit side. And in the credit side, you can see the interest received, discount received, dividend received, and all those investment kind of things are enlisted in the credit side. Okay. And if that is net loss, that will be transferred to the capital account or the balance sheet from the credit side of the P&L account. If that is a profit, that will be carry forward from the debit side. Here it is a net profit will be written here, and if that is a net loss, that will be carry forwarded from here. The most important thing to be noted in P&L account is in the preparation of P&L account, if in trading account, once we prepare trading account, if that is gross profit, that will be carry forwarded to the, that will be brought down in the credit side of the P&L account. If that is gross loss, that gross loss will be brought down to the debit side of the P&L account. Okay, this is the thing have to be remembered. Now we will see what is balance sheet. Balance sheet is also called as financial statement or final account, and it is also known as capital account. Okay, so this balance sheet, according to the American Institute of Certified Public Account, balance sheet is defined as a tabular statement of summary of balances, both the debit and credit balances, carry forwarded after an actual and constructive closing of books of account and kept according to the principles of account. So from the definition itself, it is clear that it is a tabular statement. That means it is a table statement, where there is a the statement is made in the table. So it's a tabular statement where all the summary of debit and credit balances, the debit and credit balances will be brought or carried from where? From the trial balances, and will be carried forwarded after an actual and constructive closing of books of account. So we have, it is everything will be carried forwarded or will be brought to the balance sheet from all the books of account. The books of account, which are the books of account? Journal and ledger and the trial balance. So this will be carry forward, or this will be brought into the balance sheet after after checking or after closing all the books of account, and this balance sheet is prepared according by following the principles of accounting. So major purpose of preparing balance sheet is to know the true and fair view status of the business, where the business is going, what are the expenses, what are the income, what are the kind of assets, and what are the kind of liabilities involved in the business. So the purpose of preparing balance sheet, if this comes in your multiple choice question, you have to answer to know the true and fair view of the status of the business. Okay, the balance sheet is one of the most important statements which are used by owners or investors to measure the financial soundness of the concern as a whole. To measure the business creditworthiness or to measure the financial soundness of a particular business, so this balance sheet will help. Okay, and this balance sheet is one of the important statement which are used by the owners, like the business owners and investors, to show the financial soundness of the business. A statement, this is a statement is prepared to show the list of liabilities and capital of credit balances of the business on the left hand side, and a list of assets and other debit balances are recorded on the right side, which is known as balance sheet. So as we told, it's a tabular statement. So this is a statement. The balance sheet is a statement, and this balance sheet is a statement in which the liabilities and all the credit balances will be entered in the left side, and all the assets and debit balances will be entered in the right side. So in balance sheet there will be two sides, like debit and credit. So the liabilities, all the liabilities will be and the credit balances will be written in the left side, and assets in the right side. Okay. The liability side shows the source from where the funds of the business are obtained, and the asset side shows how the funds or capital were utilized in the business. Okay. According to this, it describes all the assets owned by the concern and all the liabilities and claims it owes to the owner and the outsider. If something is owned by the business or something is owed to the others of the business, so that will be entered in the liability side. And in the asset side, it describes all the assets of the owner. And there is an equation of balance sheet, that is assets is equal to liabilities plus owner's equity. Owner's equity is capital, so it can be said as assets is equal to liabilities plus capital. Owner's equity is capital. Okay. So if there is in multiple choice or in some question, like in the fill in the blanks question, like owner's equity is also known as capital. Okay. So owner's equity is also known as dash, then you have to answer as capital. Or if either the question is like capital is also known as what, so you have to write owner's equity.